I wonder if we could, we will make a start and given we're small, does that mean we might even have a small agenda or time? I don't know. We'll wait and see how it goes, but it's great to be here. And I understand also where you said, getting the light on the staff, which is fine. I appreciate actually, there is a lot going on. I've been talking with Jan over the last 24 hours and know that she's busy with stuff that we've already talked about this morning, Rob. So was so we are well with a great set of papers. So thank you for that. Why we could start with the care, please, if you'd join with me.
Moreno, Whakapapa, Namu, Timoana, Tato, Terry, Aro Atu, Aro Mai, Atu, Tato,
Oh yeah, thank you. Thank you. That's great. So we do have two formal apologies. One from Boz, who I think is Crook, and Fran, who's taken a well-earned break. I just recognise you got to pop out for a bit during the meeting.
Yep.
I think otherwise we're all here. Rupert and Rachel, thank you for being here as well. That's not an apology. I know I'm dealing with the apologies. It's great to have you guys here as well too. So I'm going to move that we sustain the apologies and Isaac's short absence. Thank you, Rob. I'll put the motion. All those in favour, please say aye. Aye. Those against, it's carried. Just to continue that, Rachel, welcome. You are most welcome to take any part and full part in the meeting, I guess, other than voting, which technically it's got to keep to the members. But I do appreciate that you folk are here too. So strong encouragement from me as chair.
We also have Sefton online now as
well.
well.
Sefton's online, and we've got Earl online. Good day, you guys. Welcome. Good to see you. Hopefully, we can just take my agenda as it comes. It's probably 20 minutes away, Earl, before we've got to you, or 10 minutes, if that's okay.
Okay. I'll
same for you, Sefton, if you can hear me as well. So won't be too, but still won't be too far away. Any matters coming up you need to note your interest for now? Any acknowledgements or tributes we should note? No, at this stage. Radio. I had no advice of public participation, and there are no actions arising, obviously, nor have I been informed of any urgent business. Nothing we need to throw up quickly as a step. No, breathe. Okay, that gets us to item 8, which is the first item is the minutes of our last meeting, 13 May. I'm going to move from the chair. We take them as true and correct. Yeah, so we're going to. We take, okay, it's Chris's turn this time. Is there anything in the minutes that you do correction, accuracy that you would want to note? Being none, I'll put the motion. All those in favour, please say aye. Aye. Yes, it's carried. Stephen, just one little question. If there's any action that came out of it, it was we considered the sensitive expenditure policy, and we're just keen that it was updated and noted that it should also apply to elected members. I take it that's happened.
Yes, it is.
Brave. Good. That's great. Sweet. That's good. Oh no, I've got a question which will come up later on. Actually, Earl will answer it for me when we get to the Treasury position. Okay, that's brilliant. So action's done. Thank you. That gets us then into our information reports, and indeed the first one is finance and audit. Earl, I said 20 minutes was actually down to about 3. So, look, Charlie's not here, but I understand you're standing in, so thank you. Very much appreciate you being here. So let's take it from you. Then we'll consider the financial reports. Then I'll invite Seth to talk about the interim audit, and then we'll get Earl onto the subsequent Treasury. So,
So first of all, I'm Victoria Chopoli. I'm the new finance team lead here. And I'm filling in today on behalf of Charlie. So I'll take the report and all the attachments as read and just give a brief commentary about that. So as at the 31st of May, we reported an operating surplus with revenue slightly higher than budget, and expenditure was tracking below budget for most activities. Land transport continues to face external cost pressures with primarily due to emergency works. Rates arrears have almost halved, with current arrears sitting at 2.2% of annual rates in comparison to the 4.1% that we reported at the previous risk insurance meeting. So that's good that that rate's come down. And we've also had a positive audit outcome to date, which we got received in virtually to give us an update on. So yeah.
Brilliant. Thank you for that, Victoria. That's really superb. And again, some reasonably strong clarity in reporting. So the report's the 31 May. We've got a month to go. That month has actually passed, I suppose. I appreciate that you're in the madness of year-end balances, so I won't ask you too much about the 30 June position. Do we have questions here, Victoria, that relate to the results as they stand?
The only question I had was just because of all the bad weather we've had, washing out of things and the costs associated with all that, how does it actually end up washing through the budget? Because you sort of assume you're going to see some big negatives somewhere, but does it actually work out that way, or is there you cut costs to sort of fit? How does that kind of work, flow through in terms of those additional costs we wouldn't have budgeted for?
Well, there's various levers that we can to work with those costs. There's also different subsidies and things that Waka Kotahi gives us in relation to several weather events. So I can't really comment specifically today about that, but that's sort of what we will.
So there's a big wash up through all those processes that we sort of we'll see in year end, but effectively.
Yeah.
It does have a significant impact on our position.
Yeah.
Even though we get the 71% for all emergency works and we claim fully, it's obviously, still 29% that we have to find. But also importantly, all of that emergency work has to be done with the same resource from council, human resource. And it can knock out other programmed work and delay or cancel items on our work program. So it is very disruptive, and if you have 3 in a row, it's extremely disruptive. So sort of the whole thing has to be rejigged. So it's a financial and an operational cost to this. You're right, Councillor.
So reading through the papers didn't get a feel for kind of what that might actually be.
No, that wouldn't be
me not missing, or that's too early.
That wouldn't be something that appeared here necessarily now. You would definitely see it in the infrastructure committee.
Right. Thank you.
Chris?
Cash flow timing with the Waka land transport, sorry. Do they pay immediately or next month, or like do they like
71%?
how does the cash flow go with that?
So we submit regular claims, and it really just depends on the work that we've completed and the invoicing.
And they pay instantly?
They pay monthly,
20th,
I guess, Victoria, my question was really following from Isaac, which is really good, which is just the flow through the accounts. I know I should know the answer. So we've got a net 29%, I think you said 71% subsidy. So a net 29. Is that normally OPEX or capital in nature? Does it go? In other words, does the spend come through the P&L, or does it go straight to the balance sheet in the form of new assets?
I believe CapEx, but I would have to double check that.
It's got the R&M as opposed to capital.
It's almost exclusively remediation of existing assets. So it'll go through.
So I was interested also, Stefan, and you mentioned the 3 events, and it comes up when we look at emergency management, and you've been well and truly publicly in the media over washout and bridges, etc. Is there a risk that we have any impairment at 30 June in our assets?
Potentially, I don't have that information in front of me right now. But
I appreciate you won't necessarily have a direct answer on that one, but I wonder if it's something that we're going to have to consider. I don't know. I'm only asking a question in principle, given we've been knocked about a fair bit, including our capital assets, as to whether there is actually an impairment that we would have to contemplate in terms of the accounts. I'm conscious I'm saying that in front of Sefton. I suspect Sefton's already got that as a prime question on his list of things to do. Going through.
What does that mean?
And impairment means, we have a, let's take a bridge, just hypothetically, we'll have it on our books as an asset, and we will be writing it off over time by way of depreciation. But it's also an obligation on us as owning that asset to consider, is there any other event or circumstance that would say what otherwise is its normal written down book value has been affected? And that would mean that we would probably have to consider a greater write down of that asset. It might be recovered if we repair it, but equally it could be an impairment that's permanent. It would depend what would happen. So look, Victoria, I don't know. I mean, I appreciate you having that. I presume is something that you folk will be considering as you do the 30 June balance, as to whether any asset in our balance sheet's actually impaired, albeit it could affect our final result in terms of the P&L. Okay, brilliant. No, that's fine. Is there anything, other questions? Can I just wonder the grants and subsidies table? So I'm looking here at page 20. And it's probably just helping you hear a bit of local government knowledge, Victoria. There's the Freedom Camping balance of $82,000. Why do we account for that as a separate balance? In fact, even where does it come from? What's the source of the income? Am I asking a question that we've already answered before?
Yeah, I think you did ask that before.
Did I ask that before?
The money came from central government agency. It was external. It was third party sourced. I don't know if that helps, but it was.
We have to use dedicated purposes
for that purpose.
Right. Yeah. Okay. Cool. No, that's fine. That's good. Appreciate it. I won't ask any more. Okay, and I want to ask you about the continuation of the short-term borrowing policy, but we'll get on to that in a wee bit. Is there anything else folk then would like to raise at this point around the financial results at all? No? Right. Well, thank you for that. Victoria, Sefton, can you hear me okay, mate?
Yes, I can, Bruce. Thank you.
Welcome to the meeting, Sefton. And look, you're here at my request, not because I had any concerns, but actually just recognising, Sefton, that you have done an interim. We're obviously post the state now, so it's the mad rush for both our side to develop draft accounts and you to start thinking about year-end audit. I just wondered if there was anything you would care to share at this stage, please, either out of the interim audit or what you're observing at the moment. Appreciate your thoughts and contribution.
Sure. Oh, thank you. Thank you for that, Bruce. Just confirming the audit update there is very concise, and I think it sums up very much the position that we're at. We've completed our planning and pre-final, including our interim visit. We've gained an understanding or updated our understanding of the business processes, both financial and non-financial, performed the walkthroughs. Based on that, there really isn't anything that's come through that's to be raised both to management or to the Risk and Audit Committee. Our sample testing was done to 31st of March, and there were no issues there. We've covered off revenue and receivables, purchases and payables, payroll section, cash and cash equivalents, property, plant and equipment, and borrowing. So those are the areas that we've covered off as part of the interim testing to date. So by comparison to the previous year, we're well ahead of where we want to be. So yeah, thanks for the support from the finance team. Based on that, there's been no change in the areas of audit focus. We still have the infrastructural valuation that'll be taking place this year. The fair value of the land and buildings. We'll also be looking at the accounting and disclosure of the new water entity, and also just the regular risk of management override, which is just journal testing and the like. There's also been no changes in the performance information and the material measures that we anticipate or propose to look at. These are all covered off in the audit plan. So there's no change to that. I just wanted to touch on a couple of things there. We had anticipated that we would cover off the infrastructural valuation by now, but due to the timing of the valuation work, that was not achieved. But we will be looking at it as soon as we've agreed with Charlie management to make sure that they provide us the valuation report as soon as it's completed. probably in late August or very early September, but we'll get onto that as soon as we can, just so that we can try to beat the rush and the congestion at the during September when we plan to come in. The other thing about the accounting and disclosure, the new water entity, we've agreed with Charlie and also with all the other Wairarapa councils that I look after, that we would work with the Tararua appointed auditor, just so that we can have consistency in the accounting treatment, that we're all seeing the same thing and same understanding, so that, you know, come the end of the year, that there is no disagreement about how these should be treated or how these should be disclosed. There might be an audit impact in terms of just an emphasis of matter based on that, but I think that's pretty much the only things that's come up. Other than that, Bruce, there is nothing else. We've opened up the information request for the final audit, and that's being populated by the management team as we go along. So we expect that that'll all be in place, ready to rock come the 14th of September, when we will start the audit.
Look, thank you for that. That's really helpful, Sefton, and appreciate that. Victoria, there's no further delay anticipated over the infrastructure valuation.
Not that I'm aware of at the moment.
No, Chair, if it's right, could I just ask or get a point of clarification in terms of the infrastructure valuation? We were also finalising an asset management plan.
Mhm.
How does the two relate?
Is it register or is it management plan?
It's a register, yeah, and a management plan which goes on top of it. Because we didn't have a detailed, as far as I was aware, a register of all of our assets, including infrastructure
The
assets.
register might be done in time for that. Whether we've got a detailed asset management, well, we'll have a strategic asset management plan that sits over the top, or whether we've got one that goes down into each vertical area of asset class. I don't know. I have to go back and ask the team about that. I don't know how much they interlink. It's a question I'd have to ask the team. At a detailed level, I don't know what the intersection is between vertical amps and valuation. Whether they rely on one another or not, I don't think they do, because we've managed to value our assets without a vertical asset management plan up until
That's the risk, though, isn't it?
But we might have a better, that's right, we might have a better understanding of value.
Yeah, you want your asset management plan for your LTP. It's critical for your LTP in terms of your forecasts and estimates. And indeed, I would be keen to see it in relationship to the current valuation. Yeah, I presume we must be able to provide our valuer
List of assets.
Yeah, otherwise he can't, he or she can't value the exercise, and we're in deep strike if that's the case. So yeah, okay. Look, I wonder, just Rob, you've raised a good question. I just wonder, Stefan, if somebody could note that, please, Amy. I think it would be worthwhile just circulating, particularly to Rob and the team here, but actually we just get an answer to that question. I think it seems a reasonable one.
Yeah, it's just an update of where it could be. That would be helpful, I think. Yeah.
Okay, look, I'm just keen to this. Look, I really just ask you to please, and I'm sure you are. I know Sefton's approach, that you do keep close contact with Sefton, that we don't have any, when I say hiccup, wrong word, but any further delays, because obviously I have seen, unfortunately, too many audits delayed with valuation issues, and I'm appreciative, Sefton, that you've said you'll deal with it more or less the day it comes in, which is fair. Thank you for that. And I would just be keen that we have that assurance that the ongoing contact between the two, we're going to say the two teams, we're going to say two sides, we should say the two teams is regular and constant, so that we can keep on top of that. That's really great. Folk, we can probably let Sefton go, but any other question you guys want to ask us, Sefton?
So he answered the one I had.
He's basically saying tickety boo. He's indicating that they're going to have a consistent disclosure, presumably note disclosure, Sefton, over the transfer to 3Y plus T.
Yeah.
But that actually it might also have some form of disclosure in the annual report. I don't presume that's qualification system, but one drawing the reader's attention to key matters. Otherwise, we are trucking on, and I know you'll be doing the hard yards for the team, Victoria. Brilliant. Okay. Thank you for that.
Thank you.
In which case, Sefton, we'll leave you in peace, and welcome in Earl. Good to see you here, Earl. Thank you very much.
Thanks, Bruce. I'm out now.
Yeah, thank you for being here, Sefton. All the best, man.
Thank you.
So Earl, welcome in, and again, perhaps for context for me, Earl, very interested as always to get your general update, and obviously, I think we had your colleague with us at the last meeting, no big drama over there. But we've got the continuation of a policy which technically keeps us in breach, but of course was always based on the current context and conditions. I'd be keen to hear where you are at with that in terms of recommendations to us going forward. Thank you.
Can everybody see that presentation that I'm sharing on the screen?
Yeah, we can.
I have circulated the presentation, and as previously, more than happy to have that circulated to the members of the committee. There's nothing.
Just want to say, Earl, we're having trouble hearing you, mate. We see if we can turn you up a wee bit.
Turn you up.
Right now, Earl?
How's that?
Oh, that's better. Thank you. Yeah.
I was just saying the hard copy's been distributed to the team, and more than happy for that to go to the committee. You know, there's nothing in there that we have a problem with going into the public sector, so to speak. Okay, so first I'll start off with where we are on the 30th of June. So as you alluded to, Bruce, we're under policy. The policy states that if peak debt is under 30 million, it's at the CEO's discretion, which we've been using for a while now. But from the meeting, I think 2 meetings ago, when I attended, the committee was comfortable with us having this policy discrepancy based on the outlook for what's going on, and also the impending transfer of debt via water. So that position hasn't changed. And here it is here. So we've got $34.5 million worth of debt at a weighted average interest rate of 2.86%. We also have 4.1 million of working capital as at 30 June, which will probably be eaten up a little bit by now. And there was 2.1 million of term deposits, which were one of them was put in place to manage the working capital demands and take advantage of higher interest rates. So the term deposits are earning us 2.86%. We're earning us. I think it's I've missed that off. It's 3.3%. So the actual return on the investments is higher than our debt costs anyway. So getting on to where the markets are, and then I can come back to the reason why we think debt should be where it is. So it's all about the Middle East, obviously. You know, in mid-June, we had oil at $72 a barrel. We had local markets here substantially downsizing their projections around where the cash rate would have to go to get inflation back under control, and broadly in line with the Reserve Bank's still held view that the cash rate can go to 3 to 3.5, the neutral rate, to get inflation back to its target. Since then, we've had another acceleration and an acceleration in activity and attacks, and that's driven oil, Brent crude, back up to about $91 a barrel now. So still well below that peak of $125, and that's despite threats of the Houthis disrupting the Red Sea, etc. And there's been stuff on the wires just this morning about that. So the market is more relaxed, shall we say, about at this time. Markets get bored with things, so that might be something to do with it. But the other thing too is that global oil demand has fallen. Users of oil have rebalanced their purchase mix and where they get their oil from, and the Saudis have managed to get quite a bit through those that north into the Red Sea. But certainly we haven't seen a spike up in the price that we saw last time. Now, what does that mean for interest rates? Well, the US 10-year bond rate is back up around 460, got down to around 445. and the New Zealand dollar is, while it's bounced from its lows, it's come back a little bit, which will be helpful because the Reserve Bank was a little bit concerned that if we went too much lower, that could be inflationary. So, as we know, the Reserve Bank hiked earlier this month, 25 basis points to 2.5, and implied that a neutral rate of 3.5 is probably still a realistic range. And it made it clear that there will be, you know, it does expect to make further hikes without the S in brackets. The market's currently pricing a peak of around 350 to 375 by the third quarter of next year. Our latest inflation data was no surprise. It was in line with expectations. That was for the second quarter. And the main component in the inflation increase was energy-related costs. In fact, rental costs fell the most in 25 years. So we are starting to see a softening in some of these really sticky non-tradable inflation levels that we've had for a long time. So because of the housing market going sideways at best and coming down, rents are actually falling, and we're also seeing the increase in insurance and council rates is actually coming back. So while, you know, if rates go up by 10% and they go up by 7%, that's a fall. You know, it doesn't feel so good to the punter when they're still paying 7%, but inflation does come back, right? So you've got to have these prices continuing to go higher and higher and higher to have inflation keep going up. And we are seeing some relatively positive signs that non-tradable inflation is starting to come back. Now, you know, the government's talking about a 4% cap on rates, but that's not till 2028 or 2029. And you know, a lot of the revenue and a lot of the costs of the council, you guys suffer through the impositions on central government. There's loopholes anyway, so who knows how that's going to how that would happen, and if, you know, who knows who's even going to be the government. It's a pretty close situation at this stage. But taking all that into account, we think that the Reserve Bank is reasonable and expecting inflation to get back in its targets within the next 12 months. So our core view is that inflation, the cash rate will top out somewhere between 3 and 3.5, and the risk still is that things turn pear-shaped. And if things turn pear-shaped, and I'm talking globally, you know, that's a very specific economist, financial market person's term, pear-shaped. And I could probably be a bit stronger, but if things turn pear-shaped, the response has to be lower interest rates globally, right? Because if the world goes into recession, governments haven't really got a lot of ability to fiscally pump up demand, because we're all, you know, all Western governments and all governments have basically borrowed so much through the GFC, through COVID, et cetera, that they can't go and borrow hundreds and hundreds of millions of dollars, or in the case of the US, trillions of dollars to try and pump up a weakening economy. So central banks would have to react by lowering interest rates. That's still the ground zero view, is that if something really bad happens, it's going to be lower interest rates, not higher. So we think that the cash rate going to 3 and 3.5 is going to be enough to get our inflation under control, and we're comfortable with that. So we've got the Federal Reserve next week. No change expected, but the market's expecting one hike this cycle, taking it up to a 3.75 to 4% range. The RBA meets in August. Market's expecting no change there, and there's a 25% chance of a 15% chance of a hike in this cycle. So the market's basically saying they think Australia is done. Now, they didn't cut as much as us, and so they don't have to hike as much. But what's happening there is that while Aussie inflation is higher than ours, their economy's starting to slow. Their house market, which never reversed, their housing prices have been going up. COVID was just a blip, and then they kept on going again, whereas ours went peak and then crashed, right? So, but the Australian economy is starting to adjust quite quickly, so that's going to have implications for us, because, you know, that takes away some immigration and some wage pressures, because suddenly you can't go to Australia to get better deals or better wages, and, you know, it means that, you know, suddenly our demand for our exports is going to be weaker in Australia, et cetera, et cetera, et cetera. So that's got implications for us. The market expects the Reserve Bank to go in September. We think that's reasonable, but we think that, you know, they'll do one more to 3 and then they'll stop. So that's where we're seeing it. So the activity over the last week or so has been interesting, but it hasn't changed our core view that 3 to 3.5% is going to be enough to get inflation back into control. And if this Middle East thing really deteriorates even further, the risk is that the world goes into recession. And that's not good for anybody. But certainly you have stagflation, and the only thing that central banks can really do is either stop hiking rates or bring rates down to try and get things going, because governments haven't got the stimulus ability because there's just so much debt out there. Okay, so that's our core view. Little picture, there's oil prices. As I said, they've jumped up, but certainly, well down from where they were in, in that peak there. And, they're around levels they were in sort of 21, 22. So these aren't exceptional. These levels are higher, but they're not ridiculous. These ones were ridiculous. So we'll just see how things develop. But in perspective, it's kind of like, it's a much smaller increase than we've seen over, when it first happened. Global inflation is starting to, so the target is those dotted lines. As you can see, China's starting to sneak into the bottom. They're looking for a bit of inflation, and we're starting to see it start to turn down a bit. But we expect that might be delayed just a little bit as this next thing, these next price increases, these oil spike feeders through the system. But in general terms, average oil prices will be lower looks as though they'll be lower in the third quarter than we're in the second quarter. Talked about where we think interest rates are going. So the market's expecting nothing in Australia, us going up to 3.5 on a bad day, and the US maybe one hike. Economists are split, which is interesting, which is, there's always a joke that 10 economists are reading 11 opinions, but we've got sort of 5 here, and there's sort of a 60-40 split. 3 of them expect the cash rate to top out at 3.25, and 2 of them expect the cash rate to go up to 4%. Now, we're in the 3 that expect it to. We think it might go to 3.50, but we're in the camp. We're in the ASB, RBNZ, and ASB camp at this stage. We think we spec and BNZ are. We understand their reasons around it, but we think that they're underestimating the impact of not too much higher interest rates will have on domestic demand in the economy. But this is currently this is just a day or so old. So as you can see, there's still quite a big difference in view on where things are going. If we look at where rates are, there's a big gap between obviously short-term rates and long-term rates. These swap rates, which are the basis for what you pay your borrowings from the LGFA, are still not back to the peaks where they were at the start of the year. They're all the same or lower. So while there's been a lot of noise, they fell and they've gone back up again, but they haven't really broken out of those ranges. So it's interesting that, so we had this thing kick off in February, so you had that move up, but it only took them back to sort of where they were, back in sort of last year. So these moves are interesting, but they're not sort of, life-threatening. And if we look at 10-year rates, a similar sort of story. In fact, they're still relatively low compared to where they've been historically.
Can I just ask a question, Ariel?
Yeah, sure.
I think from the government's perspective, though, that they were projecting the rates to actually continue to go down or to level off, that the fact that they went up again sort of goes against what their economic planning had been. Is that correct?
Well, they've got a problem, right? Whoever's in government in November, because there's just so much debt that interest expense is now such a big number, right? And a 1% increase in a 1% increase in interest rates is actually takes a lot of money out of the system. So what it means is, as I go back to it, there's very little ability for whoever's in power to stimulate the domestic economy if we start to see a global recession by tax cuts or throwing money around or doing whatever they like to do historically, because the borrowing capacity of New Zealand Inc. is actually really tight. Our debt levels are lower than a lot of other countries, on the face of it. But the thing is, we're a country of 5.5 million people. We're the size of Sydney or Melbourne, and we have natural disasters. I mean, Sydney doesn't have an earthquake that costs 30 billion every 20 years. Sydney doesn't have floods. Australia's a bigger country, so we have to have a lot of headroom here because we do have the potential risk of those disasters. So that's why our view is that New Zealand a much lower level of interest rates at the short end is going to not, you know, that's all that's going to happen to actually get inflation under control. But you're right about these longer term rates. They're a problem for the government. They're a problem for balance sheets, and they're a problem for, luckily a lot of your debt's going across the water entities in 12 months time, because those new water entities are going to be spending a lot of money, a lot of debt, and their interest expense is going to be a very, very important thing for them to manage, because they're doing this in a cycle when things are sort of like getting towards their peaks again. So their decisions that they make are going to be quite interesting. We're involved in a few of those, so we're trying to guide them through the perils. But certainly, these high interest rates aren't beneficial for fiscal policy going forward.
I suppose the point to keep in mind, and appreciate if you could come back to this at the end of your presentation, is that the new water entity, because of the situation they're facing, will look to balance it out by passing that back to consumers.
Absolutely, and that's why, interestingly, all this financial engineering, there's no magic bullet, right? Whoever borrows the money has to pay the interest expense. Somebody's got to pay the bill. So whether it's the ratepayers through their rate bill, or whether it's through a water charge or whatever, ultimately it's got to be, the water's got to be more efficient. Otherwise, the same amount of money's going to something different, right? So the only thing we can hope for these new water entities is that they somehow are more efficient in doing stuff, so they borrow less than they would have if we had the status quo. If they just do the status quo, it's just a different income flow to them from the punter. The punter still has to pay. There's no magic money out there. So you're absolutely right. So that's the worry, is that if the water entities, for example, didn't manage their situation as efficiently as the councils have historically, there's going to be extra costs, isn't there? Because it's going to take the savings away. So that's why that's why the council shareholders, and we're saying the council shareholders, water entities, you need to make sure they're really focusing their minds on managing their debt costs really efficiently, because that's going to be one of their biggest expenses. And they need to do that properly. They need to do that properly, otherwise your ratepayers are going to suffer, So that's
but I suppose the other issue for us, and other councils face this as well, is given the need to invest more in infrastructure, the fact the debt's likely to go higher at increased interest rates over time.
Yeah, well, I suppose, if they're doing a 10-year, let's say they've got a 10-year capex program when they get it going, and they average it over 10 years. One would hope that they're sensible enough, so over the cycle they sort of average out. Let's hope they don't go, our rates are at the highest they've been for 5 years. Let's just borrow the whole lot forever and shut our eyes. That's probably not the smartest thing for them to do. But who knows? That's what their board will decide.
Yeah.
Okay.
Thank you for that.
So just quickly, the reason why the currency is interesting is a couple of things. Is that it's been down at sort of 10-year lows again, getting close, and that's been really good for the export sector, right? That's one of the it continues to be one of the shining lights in our economy, is the high prices our exporters receiving and a weak currency. Historically, if dairy prices and meat prices were high, the Kiwi dollar tend to go up. We were a commodity currency. That all turned on its heads after COVID, and we've had the Kiwi dollar going down and our commodity prices going up. So this is a good news story, right? And the Kiwi dollar is still weak compared to what its fair value is. The good news here is that it's bounced off these lows. So the Reserve Bank, we're hopefully not going to get too much of an inflation impact of the currency being below long-term averages, because we still are seeing deflation from countries like China and Southeast Asia, who are producing so much product to export, and that's keeping a cap on imported prices. I mean, oil's different, it's just a fixed cost, right? But certainly, so the Kiwi dollar is doing its job, and that's helping the export sector, which is really positive for the rural regions. That's why we've got such a strong two-speed economy in New Zealand at the moment. We've got the North Island, big cities really battling. We've got rural and South Island doing really, really well. Unfortunately, the North Island's 80% of the population. Unfortunately, exports are only 25% of GDP. If we were a proper export nation and our exports were 50 to 60% of GDP, New Zealand would be going through a boom at the moment. But we've just our exports haven't grown over the last 50 years as a percentage of GDP, which is a structural problem for us. So the poor old farmers and the exporters are doing a great job, and the currency's helping, but they're just helping the rest of us stand still, because we've got this inertia in the cities. So there's a real dichotomy between the cities and the rural sectors of New Zealand, and no surprise given what's happening.
But Errol, do you want to comment again, just translating that back into the Wairarapa, for example? The impact on that is a positive thing, would it not be?
Absolutely. So it's a
Yep.
positive for your farming ratepayers,
Yeah.
but also the Wairarapa has got quite an interesting dynamic. You know, you've got people on fixed incomes, you've got people on benefits. So there's a mixed community, right? And there's towns which are probably in the top quartile of wealthy places in New Zealand. And there's ones that are in the lower quartile. So you've got an interesting mix of ratepayers. So, but overall, this strong farming sector is certainly a positive for your community compared to, say, the ratepayers of Auckland City. That's for sure.
Yeah, thank you.
Okay, so if we go back now to where you are currently, so a couple of reasons. So the reason why we're here is that our view is that at the moment, when you take into account credit spreads, because the problem is, like, if I look at these swap rates, so the 10-year swap rate is currently, the 7-year swap rate is currently sort of 4.4% or so, let's say 4%. So, you know, if council pays, theoretically council pays, let's say you paid a 50, 60 basis point credit margin, you'd be paying, you know, 450. The problem is your borrowing costs are based on the government curve, and since basically the last 4 years, that the swap curve, which is where banks borrow and they're AA- rated, they are paying less to borrow than the AAA government rated in the LGFA. LGFA is AAA rated, government's AAA rated. They pay more in the international markets to borrow than the banks do, because the world's full of AAA government debt. So if I'm the ANZ, I go and borrow for 10 years, I pay 4% as a base rate. If I'm the LGFA, if I'm the government, I pay 430. If I'm the LGFA, I put 470. So suddenly your cost of funds for 10 years is not 450, it's 520. Now, if you borrow short term, you only pay a 25 basis point margin, and the LGFA short term borrowing cost out to 1 year is the same cost as the banks. So let's say the cash rate is 4%, you're going to pay 4.25. Whereas, you know, one of the reasons why we've been attracted to keeping your borrowings relatively short is there's a real tyranny of credit margin. You go longer because you pay a 25 basis point cost over and above the base cost of funding for funding out to 1 year. You pay between 70 and 120 basis points between 3, 5, 7 and 10 years. So it costs you a lot more to borrow longer term just because of credit markets. Now, intuitively, you would think that the AAA government should have a lower cost of funds than banks, right? But that's kind of a sad indictment of how much government borrowing's been done around the world. But and unfortunately, a council like yourself is caught in that, even though your credit metrics would be better than a bank, for example, if you're borrowing with your own name. So we've got that. We've got short-term rates lower than long-term rates. So when that all comes to it, when we do a mathematical calculation, we go, well, if you borrowed for 10 years currently at 5.5, and you can borrow on a floating rate basis currently at...
Sorry, you've cut out, Earl.
He's muted himself.
No, he's got an issue with his sound, I think. I think it might be his microphone.
Yeah, Earl,
It's maybe a headset.
I just wonder whether your microphone may be at fault, but
Get your info.
How's that? Can you hear me again?
yeah, there you go. You can hear now, Earl.
No, you gone again?
Maybe my headset's going flat.
Yeah, I think it might be, to be honest.
Oh, it's a
Yeah.
How's that? Can you hear me now?
Oh,
Yep.
brilliant. Best we've heard you all afternoon.
Oh yeah, that's coming through. That's coming through the system. Maybe I should not use the headsets. I should use the system. Okay, so getting back to what I was saying. So you've got short-term rates that are lower than long-term rates, and at the peak, we think floating rates might get to 350, let's say. So your cost of funds for a floating rate basis might peak out between 3.75 and 4. If you borrow for 5 years at the moment, it's costing you nearly 5, 10 years costing you nearly 5.5. So the maths means that the cash rate if you borrow for 5 years, the cash rate's got to go to about 5 to 6% in the next year or so to you to be worse off. Now that's not a risk management, we've got to manage risk, right? So sometimes we've just got to suck it up and borrow fixed because you've got a policy. But there's two, once we get over, and we've got that set up. So once you get over 30 million, we go, well, it starts to get a bit risky, guys. We just have to do stuff. That's why we've got that discretion. Over 30, we can't just go, no, we're playing the curve and we think that's a smarter thing to do. We go, no, we'll give you some certainty. But when we look at that $35 million worth of debt currently, nearly $30 million of that is water related. Now, I'm not sure how much is actually going to be agreed and go over, but let's say even half of your debt, half of your water assets are actually agreed and they go to the entity, your debt's going to drop on a bad day back to 20, let's say, and maybe quite a bit lower. And then it'll build up as you do other things at the council. But there's no point in us getting the council to pay a whole lot of high interest expense for the next year just to give some loans to the water authority. They can sort their own stuff out, right? And hopefully they're doing that, and hopefully they're making these decisions and looking at your book and making some decisions. And other water entities we're looking at are they're looking at the councils that are coming in, seeing what their debt profile is. They've got their policies in place and they're making decisions, and they're doing forward swaps. They're hedging and they're doing stuff they need to do to manage their risk, right? But we don't want to be penalising you in the next year to set them up because they can do that themselves. So what we're saying is, because that debt's going to drop, and because mathematically we think borrowing for 5 or 7 years is a bit silly at the moment, we're quite happy to stay where we are. So that's the logic in that. And to be perfectly frank, if your debt was going to stay at 35, we would have done some stuff over the last 6 months. We'd be in policy, we'd be in the theoretical policy now because that's your debt, right? But because it's going down, we think we're better off, and we've been paying 2.8% and lower for your average debt costs now for 18 months. If we had a fixed 18 months ago for 5 years, we would have been paying 4. So we've already saved that money anyway. So we've got a big buffer. So my view is, in this transition period, let's give the ratepayers of South Wairarapa as lower interest expense as possible, and then we start to look at it again when our debt gets cleaned up and the stuff goes across the water, and we manage it as a council. So putting my council hat on, that's the best position for you in our view. Does that make sense?
Yep. Yeah, it does. But I suppose looking ahead, council's got, in terms of an amalgamation process, a lot of costs such as transition and things like that. So some of that's going to be met through borrowing.
Yeah.
Yeah.
Yeah, but let's say, I mean, we'd be comfortable even if your debt was, sort of close to 25 again or something, and it's not going to be anywhere near that. Because our view is we're going through the cycle now. So what's happened is the tightening cycle has started and interest rates are forward looking. So the swap rates of the 5-year swap rate of 4% is already factoring in a cash rate peak of at least 3.5 or even higher. So when we start when the Reserve Bank finishes, then the market starts to look at the next easing cycle and those rates come back. And by 27, 28, we think we're going to be very well placed as your debt starts to grow again to be starting to term out and get involved. So we think we're in a pretty good space in the cycle.
And the question will be when you're right about the transition costs, but they're not going to occur
for quite some time. I mean, it's 2 or 3 years, even more further out. So basically, the other question then is, well, just confirming that the current hedging approach is the right direction to carry on with.
Yep.
Essentially, but that's going with
putting that on the record.
Yeah, no, I don't think it should be. Which is just one thing, because you quite expertly said we've got the allowance under 30. We're at 34.5. So we are typically into the next band of borrowing. I know that doesn't change the basic rationale, but I'm just wondering whether as a committee we should acknowledge that.
Yeah, well, because we went over 30 about, I think, 3 months ago, and all that new debt was water related as well.
Right. I think we should note specifically, Rob, in our resolution today that we recognise the ongoing policy. Is relevant.
Yeah, that makes- I think-
Even though, as you said, Earl, it's moved to nearly 35 million, but it's still all water related.
It is water related,
Yeah.
and the hedging policy accounts for the.
Yeah. Okay.
And that's what I was actually, thank you, Bruce, that's what I was gonna request, is that the committee acknowledges that, because the policy does make it clear that CEO's discretion comes out at 30 million, and it doesn't define in the policy that it's above 30 if there's some other debt. And because when we wrote the policy, we didn't sort of think about this water amalgamation and debt transferring. So I think that from a process point of view, if you note that, that's very helpful.
Yeah. Okay. Good. Are there any other questions for Earl at this stage? Really helpful.
That was good.
That's really helpful. Thank you, Earl. So we will, just see if we can fabricate a quick resolution. That's okay. It was an old man way of moving my chair, wasn't it?
Okay, well, thank you much. Thank you much for
very
running.
much. Appreciate that comment. Thank you for your time.
I need to get down there. I hear some Martin Borapino calling my name. I need to get down there soon. Thank you very much, guys. Take care.
Yeah.
Okay, so the resolutions are that we receive the finance and audit update. Thank you. We note that there are no, so I think we need to add a third one, which is that we note the debt position
Is above the
is above $30 million
threshold.
that the majority of debt remains water related
Will transfer.
and transfer within 12 months.
Yep.
Can you say that again? Just people talking, sorry.
Oh, yeah, okay. Right. So we're saying we note that council's debt profile now exceeds $30 million, and that the majority of that debt still relates to water, which will transfer within 12 months to the new water entity. And we note the advice that continuation of the existing tactics. I'm just trying to get it right.
Hedging policy remains
The
appropriate.
hedging policy, sorry, the hedging policy.
Yeah,
And non-compliance
remains appropriate.
remains appropriate. Thank you. Appreciate that, Rob. That's really good.
So note that the hedging, see,
The existing hedging approach
And the debt level.
Yeah.
Remains appropriate.
remains appropriate. Long one, isn't it? Sorry, there, Amy.
yeah, I actually prefer to get things written down, so.
Yeah, but I didn't, sorry, but we needed, we needed to hear from Earl before
Sure.
we, sorry, look, in fairness to you, I did think when I was reviewing last, we must be able to do a resolution here. Happy for you to read it out though, because we will get it right.
I think I've got them.
Okay, you comfortable?
Yes.
Brilliant. Well, I'll move that. Thank you, Chris. Any debate? You've been none. I'll put it all those in favour. Please say aye. Aye. Those against, carried. Thank you very much. Victoria, thank you. You've had to sit through quite a long session, and perhaps longer than we anticipated, but actually, in reality, I think it was valuable. Stephen will get Earl here. I know he always comes, but it's actually, when he can, but it's useful given the ongoing position that we're actually in. That 2.86% average cost of debt's brilliant.
Bruce, with those two terms, the short-term ones, are they floating at the time? Is that what they are?
Which page you on, mate?
So on 31, so you fund the two funds that are really short-term, the 10 million and the 17 million.
Yeah.
Were they floating at the time, or is that just like?
You borrow floating. The question is whether sorry, I should be careful.
Because they're going to keep rolling, right? So it's now, there'll be a 3.5 or whatever when they come to term, when it next rolls.
Yeah, you're right. I mean, your amount is going to change depending on the terms of when you're able to get it. Which of course is then the reason why you come back to your short-term debt. Traditionally, you would try and be within those bands, which we are not within. But as he said, you are still getting for short-term debt, you are still getting more favourable rates than long-term. So we're better to be in the short-term market. What he's saying is actually by the time the debt goes, the water debt goes, and we then have our core debt, if you could call it that, rather the debt that's associated with whatever we are in the future, including the increasing debt, which we're acknowledging will probably happen. We will be ready to enter the market when actually it's coming off its existing tightening position. I think I've got that right.
Yeah, I mean, effectively it's all floating at the moment because it's cheaper than hedging it. Yeah.
That's right. That's what it comes down to. It would cost us more to get above the red line.
Yes. And usually goes around the other way to trade the curves.
That's right. Whereas, I mean, essentially it's a risk equation. The risk is that actually, if we impose a higher rate on ratepayers now to be above that red line, we need to do that. And the strong argument is the answer is no. It is unlikely to go. It is unlikely that our interest rate cost in a year's time would require us to take it down.
But if things change, we can fix the floating immediately, can't we? Like we can do an emergency meeting.
The question becomes that can you do that at a favourable rate? And that's the issue, is when is the right time to enter the market to hedge?
Hopefully 12 hours beforehand.
Yes.
Yeah. Then Donald Trump will let us know.
Yeah, that's right. Okay, cool. Right, let's look, and I didn't push as fast through the rest of the finance. We didn't with it. Sorry, I'm not trying to reopen it now, Amy, but was there any questions around debtors or anything like that? That was you were okay?
I had a very stupid question. I think I might have asked it before, but Stefan, carryover. Is there any percentage of carryover?
For CapEx.
Yeah.
In relation to the capital works program.
Yeah, because we're underspent. There'd be something prescribed under the Local Government Act. I know from the central.
Is there a tolerance?
Yeah, from a central government perspective, with the agreement of the Treasury Minister, you can carry over.
I don't know if we've got that in policy.
No.
But do you know if is there a tolerance? Is there a level for carryover that we try and hit?
Not that I'm familiar with. I have to look it up.
I would say probably not.
There traditionally isn't. I mean, the biggest problem is that you just add whatever the carryover is onto the current year's capital plans, and actually, quite frankly, it's pie in the sky.
Yes, yeah.
It's not great practice.
No, it's not great practice.
Yeah.
Yeah. But I was just going to say the underspend, the 1% again is within tolerance levels from a central government 6% levels. Good.
It's certainly improved over time.
Yeah. Victoria, sorry, this is terrible, Amy. It's a bad process, but we're pretty informal today, I'm afraid. I did look at the debtors, and I just wondered if you could look at your page 30 or our page 36 of the agenda. It's got some very insightful, or rather the information is insightful into arrears commentary. And I just noticed that it looked like we had, if I picked this up correctly, we've had direct debits cancelled. I think that actually. Normal arrears recovery action to be taken from July 2026. Don't want to be sort of alarmist. I was just wondering, or worried even potentially, about direct debits, whether that was a canary in the mine, if you will, of perhaps harder times for people to keep up their payments. People cancel direct debits when they can't afford them. I was wondering whether there was any comment you might have on that.
I would have to talk to the team and see if there was a reason for.
The papers don't hint that there is a problem with increasing rates debits.
Yeah.
I just think as a committee, we are a wee bit, when I say we're sensitive to it, I think in the current context of needed rates increases, capacity of people to pay, I'm just looking for any indicators that that the community is finding it increasingly difficult, let alone just the general hearsay.
Yeah, I talk to the team, but it's something we can take into account.
Thank you.
Future.
The future reporting, it might just be useful, which is really, as I say, the test we're looking for is are our cash flows suffering because of an increasing inability of people not to pay rates, being unable to pay rates. And I just thought the cancel direct debits might be just one of those little clues about being the case. Okay, my apologies. I should have checked before I put that resolution that we about the finance paper about those. So I am going to check finally. Is there any other question you guys might have?
Not a question, but yeah, that information about outstanding rates and so on, and the number of holdings involved and where they are, I just found that really interesting.
Yes, very helpful. Thanks very
I wonder what Charles Thickens would make of it all.
much. You could write a sequel for them, couldn't you, Rupert? That'd be the way to go. Right, now we can move on to risk management. Stefan, please, and that would be great. Thank you.
Thank you, Chair. So, three of all been through the paper. You would have noticed that predictably a couple of risks have increased, and those are around emergency management. And that just reflects the volume of severe weather events that we have experienced over the last 6 months. And the impact that's having on fiscal impact that's having, but also the capacity and staff impact that it's having within the organisation. It's very hard for a small organisation to draw that resource out of itself each time this happens and suspend BAU at the same time. Also, we have updated some of the risks. Critical asset failure has actually, the position's improved now that we've brought Water Capital in-house, and that's starting to generate some real efficiencies. It's better resourced, there's more transparency, predictability around it, which is great. And some of the risk around government reform, we haven't changed the ratings, but we've expanded the explanations to include different aspects. So particularly around the Head Start program and any risk attached to that. So yeah, we're making an effort to keep these current, relevant for you, and adjusting the ratings where we need to. But the primary focus for us is, in this report, has been around emergency management. Thank you. Happy to answer any questions.
Well, we do certainly have the emergency management paper coming up as well. So, but having said that, I'll take questions on either at this stage. In fact, if questions or comments on our risk profile.
Just a comment on I think from the emergency management perspective, I think sort of sitting there from a councillor's other side of that, I think we've seen the impact of multiple events and how it's being reflected by, staff, the hours they've been working and the responsiveness to that. I think there are some issues within that, Chair, that we're going to look at in the longer term, which will be useful for that. But a question for you, how does this look compared to other councils in terms of that profile that you're seeing?
Yeah.
And then the question, Stefan, is the legal compliance and advice, but still remains medium. Why does it sit at medium?
Sorry, which one was that?
Just the legal compliance, I think that's 50. So one, yeah.
That's it. You got, well, look, I'll answer while Stephen finds an answer for the generalities. So look, if I look at the table on page 40, so that's got the residual risk ranking by priority. So that gives us things like climate change, regional alignment, critical asset failure, crisis management, emergency management, government reforms, economic uncertainty as high. That is actually pretty consistent with the rest of the sector. I am interested in the emergency management because you guys feel, I don't mean this unkindly on either council, but it feels a bit like Gisborne, where you've got successive events. So I totally get the point, Stephen, that, 3 events in 6 months for a small council creates a lot of challenge, and it will divert us from our real work. The question here, Rob, with those sorts of matters is I like to think in terms of your strategic objectives. We've got effectively a risk, which has actually become an event, and that's actually happened, but we've got risks that are external to our strategy that are effectively out of our city deliver. It raises questions. Normally in the situation when you're high, you'd say, well, we've got to do something. The question is, what can you do? That's the real question today. Is what can we do? Or we're, in a sense, we just have to suck this up and just go with the fact that staff will be diverted. We can't do BAU, or we're going to have to minimise BAU, and we will have to work through the process. Does that make sense?
Yeah.
And the question, and I don't sense there's anything that is that South Y can do easily, which alleviates particular burdens. So our risk profile compared to the last time we met, we had at least another event since the last year, 2 really, or perhaps it's a continuation of one, seemed like 2, is making delivery to your community harder. Without any sort of immediate short-term relief possible.
Thanks. Well, just on the legal one, I think just going through, there was nothing that stood out for me in terms of why you'd maintain that as medium. In the sense, there's no particular major legal issue on that. All of that is fairly low level.
You're arguing that it's rated too high.
Yep.
Yes, the medium is too high.
Yep.
Why is it not green?
Yep. And just to have a look at it, that's my comment.
In the absence of anything to suggest otherwise.
Yeah. Like an overall risk profile, I sort of go by a mantra of it's nice to return to green on some of this stuff.
Unless there's some legal
unless there's a legal challenge that we're actually dealing with that would maintain it at that particular level.
We'll take it back and have a look.
Yeah.
Okay, folk, any other questions?
Can I just, sorry, Chair, one more, just in terms of, it's been quite newsworthy lately, IT systems failure. Just how regularly you cast your eye onto, our IT systems being fit for purpose, or that there's nothing new in terms of product development that we're taking on board, which we're signing on to, or developing that's going to cost us more than we anticipate.
We're quite lucky in that we've got a external provider contracted to do all of our IT, and they're both vigilant in terms of the amount of testing and surveillance that they do, and the amount of education and work they do with the team to spot irregularities and sort of try and prevent any kind of damage before it happens. But they're also, and there's a bit of a commercial dimension to this as well, they're always trying to get us to advance and sort of use the latest technology. That's not always possible or affordable, but they're certainly putting options to us regularly, putting them on the table and asking us to consider them on an affordability versus risk basis. So I feel like I see a lot of that regularly, and I feel like I get that kind of assurance from the IT contract. But I could certainly, find some way of.
No, I'm just asking the question just to test it,
Yeah.
particularly within the contract in terms of ongoing increases of licensing costs. I'd be slightly worried.
Yeah, I mean, nothing gets cheaper. And I've recently approved increases for licensing costs, but it's more for us, you have to pay that unless you can find a better or as good equivalent, which isn't always possible. It's more just looking for ways to try and reduce the amount of license holders where possible to mitigate the inevitable increase in costs. But we do all of that. Yeah.
Thank you.
Just from my side, again, it's partly related to the emergency management issue. I noted that we don't have a trained in-house controller at the moment. Is that right, Stephanie?
That's correct.
Yeah. How do we cover that?
We try and recruit someone who is either trained in that capacity or could be trained fairly quickly.
Yeah.
And so it's in our job, in our advertisements, and as part of our recruitment, we're specifically seeking someone with EM experience.
So that says we have a risk exposure now. What happens if we have an event tomorrow? Where does our, we
have alternative controllers in the council that would step up.
Sorry, that's my question.
Yeah.
Do we have, we have access to alternative control?
Oh, yes, no, we wouldn't be, we wouldn't be without someone. It just wouldn't emanate from us.
I mean, and also look, I mean, I know this is not at a controller level, but I was also impressed to see the training percentage of staff that you've got trained into at least, what is it, the foundational level of emergency management, which is a matter that we've talked about in the past here. So,
and even up into intermediate level chair, the business has really made an effort to get people trained and involved in the system. So we're really encouraged by that.
Yeah, I am too, and thank you, and well done. Look, it's not, I don't think I need to declare my interest being chair of MPI's risk committee. I just noticed the bird flu. And I think it's page 57. You note the potential. Is there anything active at the moment you could tell us about happening here? I mean, obviously we now have it, the worst sort, not the more lighter version that was down in Otago a couple of years ago. Anything in particular that's notable here at this time?
No, I mean, Chair, on Friday we. Once we learnt that a second seabird had been found in Carston with the flu, we put public comms out echoing MPI messages. Those messages were just the basic, don't touch the birds, report immediately, don't let animals near them. And we also contacted our contractors on a health and safety basis, people that were in the field and maybe coming across birds, our parks and reserves people and so forth, our roading teams, because we have a PCBU responsibility to them to do that. And then we put comms out to our own staff, because our own staff are out there a lot, dog control and regulatory teams in particular. So at the moment, it's really information, education, awareness basis, and we were waiting to see if the field testing, surveys that MPI were doing over the weekend came up with anything else, and they haven't as yet. But we all know it's a matter of time before this happens. So as we start to get into what G Dub was alluding to, which is our own cleanup of mass deaths, for example, of seabirds, then we will, it's a whole new dimension where we have to have PPE, trained staff, mitigations around that kind of response. But we're ready for that. We bought our own PPE for a couple of people who are on call, for example. So we're as ready as we can be, I think, but at the moment, just in an information.
Is the methodology out, like on what, like if there is a mass bird extinction,
is there a plan for how people treat it? Like there is. That's-
MPI have been doing scenarios around this for years. So there's a very well formed plan led by MPI. But the devil's in the detail, councillor, where, you know, people are being told, for example, you know, they have to pick up the birds themselves and dispose of them, but, you know, that might not be appropriate in some circumstances for in Māori, on Māori land for certain reasons, for example. So it's just working with different groups of people that might be need different instruction. But yes, there's a plan led by MPI, which we will follow.
With the help of the regions.
Yes. Yeah.
Well, the other question I had, it was just social life. It was the social license one. We were gathering data, and I couldn't read what that was. And it said it was to be done in 2024, which made me wonder whether that was still a control that was relevant.
Yeah, that's probably a reference to the public sentiment surveys that we did, but we haven't done one for a while, so that might need
Just note I
might need to be looked at.
And just think whether it doesn't change anything in terms of the rate. Okay.
Yeah, I'll have a look at that.
Right, yeah. Any other questions or comments if I could have? Well, look, I would just go back to that table with the risks and priority. Cold comfort, Rob, then this could be a good number of our local authorities around the country and ourselves, but it does reflect substantial stress, not just on staff, although undoubtedly on staff, but actually on you folk as well. I mean, the reform one, as you know, you're going to have to make a decision within less than 26 days now, or 26 days and about a week ago. Till the 9th of August, etc. There is a lot of stress here that you're going to have to think pretty hard about. It's just the pragmatics of the risks that the sector is facing as a whole. So look, I just would want to note that. There probably, as I say, isn't a lot here that we can do. We're not rich in resources to move them around or to.
There's lots of icebergs, isn't there?
That's right, to actually deal with it. So there's a sense to which, as a risk committee, we can't say to council anything other than you're in a highly risky situation. You know, context profile. It's not like we could recommend you should be doing something different. I don't sense there is anything that can be done different at this point. We are receivers of this risk. It's very hard for us to determine a different path at the moment. Great.
So through you.
You go for that, Amy.
You've mentioned before that you were looking at risks that were prioritised. They are not prioritised. They're just ranked lowest to highest.
Oh, sorry.
Highest to lowest. So that's what we talked about previously. Was actually if you wanted to prioritise them, that might be something you want to do.
Or is something you don't go.
So who is cheap? I took highest to low being priority. What do you mean by priority?
Well,
If they're ranked highest to low, that is got a priority, isn't it?
But would you put climate change at the very top, or would you? Yeah, there's still a prioritisation process, I think, if you wanted to do it.
Look, for the sake of the conversation, I don't know. I'm sorry, I'm a wee bit lost as to quite. If it's high, and there are no other ones that are high.
But these are all high and all 12, but you might choose to show that this is a higher priority by putting it at the top.
Okay, right. I understand your point, but you're right, there's 12s and 8s. They don't, numbers sometimes in risk don't thrill me. I absolutely understand the point. The reality of it is, if I was to take the 6 that I'd read out, or whatever it was, 9 that are high, that is actually consistent with the rest of the country. My point is, what can we do about that? Because I don't think any of those we should be comfortable are in red. But actually the question becomes, what can we do? Can we divert resources? Can we stop doing something? You know, the real art of governance when you're facing risk is you do something to mitigate the risk. What can we do? That's really my question I'm trying to come to. The answer is limited.
I guess just speaking to
to risk, like at the moment with emergency management, I think we could do better on emergency management. With a part of the strategy is to get our local communities more engaged to look after themselves. But that's a really hard thing to do without pushing it on them. At the moment, we're using community boards that kind of, each community board has its own culture and nature by the people on it, and will drive things less or more depending on whether they think it's important or not. So it's really at the hands of the people, the community boards, that could really raise the bar in that emergency management. I just wonder whether there's a way that we could prioritise them a little bit more.
I think that councillor is reminding me of a conversation that we had in our risk workshop, which is that risk has to be considered as a dimension of strategy. And so, you know, when we're going through the LTP and we're thinking strategically about, you know, what kind of fiscal headroom we need to create for resilience and the impact that might have, we would be thinking about, well, what kind of impact would it have on our highest risks and so forth. So this is a useful guide for strategic thinking.
Yeah. Well, look, I agree. And I mean, Chris, thank you for your input as well. And so I think I'm certainly agreeing with Stephen. I'm just reflecting when you are in a position that the risk you face is outside essentially your appetite, or you're uncomfortable, you tend to do something about it. Right? The question is, the point I'm perhaps trying to make here is, with these ones, there isn't anything immediate that can be done. Yeah. That's really the key point.
Well, it goes to appetite, doesn't it?
Yeah. It does go to appetite, but it is equally they're systemic. So Chris, your point's really well made. You know, couldn't you make it? Do you want to make a recommendation? I mean, I'm not. Do you want to make a recommendation to council now? We are so concerned. We are concerned about being outside appetite of emergency management. You've got to crunch the community boards into shape. You know what I mean? You know, I know I'm using words that might be provocative, but you get my point.
Yeah, I do.
That actually we are probably sitting in a position where there's limited capacity to change these from these settings at the moment.
Sit on it for this month and I'll reflect. And
He's going to crunch the community.
Does your community board need crunching?
Okay. I think I probably had to make my point about 5 times. And so I'm sorry that I bored you and everybody that's listening, but I just wanted to reflect that ultimately is the discussion we have to have. Is if we're outside risk, is there anything, or what do we want to do about it? And so that's why I bring that to a conclusion. You're right. Also, Stephen, this is about appetite. Yep.
Well, how do you measure if you're outside risk? It's red.
Yeah.
Does it bother us or not?
Yeah.
Well, it does bother us.
How do you measure what bothers you, what doesn't, and then how do you figure?
Well, can I say it? You go back to my risk matrix, which says how well can we live with the uncertainties that come from being within this high risk environment. Yeah. Okay. Here we go. Good conversation. Thank you. So the resolution is that we receive and we note the information. Yep. I'll remove in a second. Do I have a second? Thanks, Chris. All those in favour, please say aye. Those against, it's carried. Wonderful. People and health and safety. Steph, please.
Yeah.
Sorry. Welcome.
Hi.
Thanks, mate.
I said Mel. Sorry, I read my notes. I should know it's May. Sorry, my apologies.
Okay, I take it the report is read. A couple of points I wanted to highlight was as a result of a recent change process that we had, we've moved health and safety into sits with HR now. So the report is being combined. So previously you obviously got a separate people report and health and safety report. So they're now combined. Just highlighting key areas in the report. So it looks a little bit different than last time. Also in the report, we had combined the operational people and health and safety risks together at the back of the report. Our intention is to actually remove this part of the report in future reporting and include it because you've got the risk management section, which we've just had, and obviously one of those key risks is health and safety. So it's a little bit of a duplication now. So that's sort of our intention, and to have these operational risks managed at the SLT level. So I kind of wanted to get some to make sure that that sounded suitable, and also that the reporting which you've received this time in this report is actually acceptable and what you actually require, because it's quite different. I've focused on key aspects which I know have been discussed in previous meetings in terms of headcount, TE numbers and the likes, and so in that health and safety space. Welcome any questions.
I appreciate that. Yes, Chris.
The working at height with the fixtures on the buildings, the last one, is that underway? Like how, like
Which page you on?
Page 90. It's basically you've got the anchors have been purchased and bought but yet installed. Just wondering what the time frame is for that.
No, so they have been installed on, I understand, on 6 key council buildings. So some of that work has been done. So we need to, update some of that stuff.
Nothing worse than buying stuff and not having them up.
Of course, yes. More questions?
Yes. So just to say that, just trying to find it. Under the background, you've got any updates to legislation will be captured and reported back to the Risk and Insurance Committee as part of this paper on a bi-monthly basis? Pardon?
This meeting is bi-monthly.
Bi-monthly, yep. So at this meeting, we'll get a health and safety update report, or just a report back on issues.
It would be this type of report unless there's anything else that you would like reported on.
Yeah.
That was just if there was any sort of legislation changes and during that period, then I'd incorporate that into this report as well.
It's the second bit. I'd just be interested in having a brief sort of discussion, Chair, about whether in fact there's a couple of things in terms of performance issues, wellbeing issues, which aren't reflected in here, but whether it, in terms from a council perspective, we should be aware of or take note of, or it should be reported to us, in which context you possibly wouldn't have it in a public hearing. You might want to move to a closed hearing to hear that, but I'm just open for a consideration or discussion of that, because quite often some of those issues end up having a media context to it, and we're not aware of it from a risk perspective, but that's just a thought. Yep.
Yeah, I think we would leave that as an open possibility that there could be matters that perhaps our level of specificity or exactness that we should hear about from a risk perspective and are important to understand, but maybe you want to have them close. Yeah.
Okay. And just obviously a subcontractor in terms of the responsibility of the council from the law as it relates to health and safety. And so I've noted in the report that, you know, you're comfortable that there are quite, you know, good subcontractor requirements in the contracts itself to report on any health and safety issues. So again, it comes back to the point that you would notify the committee if there was something cropped up there, like a bad injury or a death or something like that.
Yes, of course.
Yeah.
Even if we had a flag that emerged out of operational risks, you wouldn't necessarily be going over in any detail.
Yeah.
If any flag like that raises an SLT and you need to hear about it, we will make sure you do either formally or informally.
Yeah, just seeking assurance of a process.
Yeah.
Yep. Thanks.
Good. Thank you for that. Any other comments or questions folk would like to raise? The question I had, and I've always been interested in the table at the end, which is raising most critical people, health and safety related risks. Okay, so that's pages 86. And again, it's a bit like the discussion we just had around strategic risk. We've got residual risk ratings, generally of moderate, there's a green one sitting there. Are we happy that it's at the level of moderate? On the whole, these risks. Which comes back to the idea of risk appetite. So for, just take the first one, workforce, tenure, organisation capability, We've got some risk controls in place which move our initial risk rating from red to or high to moderate. I guess I'm looking for a lead. Are we in the right position then?
Not really.
Do we have to do more? What does management think about that one?
Well, we go.
Sorry, is my question clear?
Yeah, no.
Again, it's just saying it is what it is, but actually is it where it should be?
Yeah, well, no, it's a good question, Chair. And we go through this kind of stuff in SLT regularly, looking at whether our attrition rates are up or down, why they might be moving in a given direction, how we mitigate against the sudden loss of a specialist that takes 30 years of experience with them, and how we manage handover. Overlap so that someone can be trained as much as we can. But against that, the reality is people leave, sometimes suddenly, taking that experience with them. We have months and months of gap where we can't recruit because it's a tough market, especially for some technical areas. So we mitigate, but the risk remains moderate because it certainly isn't lower than that, so the answer to your question is that we do thrash this out regularly at an SLT level, and so these risks come to you well considered.
Yeah, no,
but at the same time, if you have a view on any of them, as you've just expressed with that legal one, we're very open to having a conversation. That's the whole idea.
Yeah, it's a really good question, because if you take, for example, the area, and I had noted this last night, conditions of employment, for example, where you've got a moderate on the side there, but things such as well-informed policy standards or procedures, well, they're just in place. I wouldn't put that as in terms of a risk profile, or the things like having EIP on available. All I'd have here is actually where there is a real risk. You see what I mean? Within those things, but they're kind of fairly standard, and I'm just wouldn't put it against a risk.
My point, slightly different role, but I think it might be helpful. If I got down to something like working with PCBUs, vehicle driving on the roads, your point previously about height. So those are quite critical and specific health and safety risks. And we have a legislative standard, which is you avoid, or you take reasonably practicable steps to minimise the risk of harm. Does moderate equate to that? Is the question.
Yeah, that's what I was
trying. If it doesn't, there is a responsibility on officers to consider what could or should be done that's in addition to that. That is a real risk question which we should have an answer for at the committee, is what I'm trying to get to my understanding. That's why I come back to this. This is always an interesting table for me. Is moderate the right answer?
I guess, like on this first one, I find that really fluffy. That whole like I'd like to see, if we do have a downward trajectory of timing of our staff, like half is a big number. Like if we can see a trend, then we can actually do a more detailed attack on it. Where at the moment it's just kind of you can't really do anything with that. But I can do something about putting ladder hooks on buildings, things like that.
Well, look, it's not a big drama. I mean, I'm hearing from Stefan that if in mind that if there are indicators that are suggesting there is significant negative trends, you're going to tell us. I guess I'm coming back to really my prior comments in the prior paper, which is actually, should we be comfortable with moderate? Why are you comfortable with moderate?
No,
You know what I mean? So I'll leave it as a rhetorical question, not as a.
I hear you, Chair.
It's not a criticism. It's just saying we need to be accurate and complete in our thinking.
No, I think it's a good challenge. And I think in areas like health and safety, we really have to answer the question whether we're happy with moderate against our legal obligations. So,
sure.
Whereas in other areas, I'm less worried. Because there's flex and whether the controls are adequate. But it's let me take that back to SLT. We'll have a think about it. I think it might be something that we need the help of the committee with on the strategic risks.
Yes. Yeah.
Where we've talked about going further in
risk appetite.
Risk, and I think that's
look, I'm in a broad sense, I want to be and for the benefit of the record, I also want to be clear, I'm relatively comfortable about the approach. I'm very comfortable that I understand as a control SLT regularly focus on this, and that's absolutely fine. This is more about, yes, the level of accountability of SLT as a committee, but it also should be the operating the other way, which is actually how can we support you? Are you comfortable? If you're uncomfortable with this, we should be aware of that firstly as a transparency issue, but secondly, we've got an equal obligation to help find a solution to the issue. And I'm just looking for that final step. That's what I'm after here. So I'll leave it as a rhetorical question rather than one that is expression of necessarily significant concern. Brilliant. Thank you for that, Mike. Appreciate that. And we'll look forward to the ongoing reporting. I appreciate you indicating a change in the way it is, but this is the changed version, isn't it?
Yes, correct.
So that, brilliant. Okay, so the answer is that we're here to receive the report. I'm going to move that, please. Thank you, Rob. I think it's your turn. I think it is. All those in favour, please say aye. Aye. Those against, it's carried. Thank you. Righty, emergency management. Again, we had probably a reasonable crack at this as we, in some sense, of the prior paper, but there's some very important stuff in here, Stefan. So, your hands.
Thank you. Yeah, thank you, Chair. I'll take the paper as read, and I'm responsible for this paper because Nigel is actually away today doing emergency management training, which is good. And this paper updates only the previous two responses, not the most recent one. And you'll note that we now have the emergency management strategy passed by all three councils, which is fantastic. We can get on to implementing in earnest. Fuel disruption remains a constant and is sort of ranging at the moment, but we are still in level 1. We're learning from each of the, each time we have an event, we're taking our lessons from that event and bringing them back. It's not in the paper, but the most recent event probably warranted set up of a local crisis management team, which we didn't do, and I wish we had have. So that was a good learning from that most recent event. You sort of do these in a de facto way, but I think there would have been value in having it done formally. You'll see that councils are, the significant additional hours going into these events, and then the staff is doing 12-hour days and often trying to handle BAU outside of that, although they shouldn't. And then taking toil to recover that time. All of that has an impact on BAU and on the individuals concerned. So the answer to that is to train as many of your people as you can, get more people to put their hand up and be appropriately skilled to be involved in a response. And we are doing that as quickly as we can, and the staff are really responding well to that as an opportunity. And we're a little bit we're missing the departure of Matt Vins, who was our alternate controller. But we hope to find someone that either has those skills or can come into the role and be trained to replace him. And you have had you may have seen the recent report from Nigel on the work that we're doing with the community boards to increase their resilience role, and that's also ongoing. It's the start of a journey with them, but there's certainly a lot of goodwill in the community boards to undertake that role, and a really important one. When we have a response, particularly if it isn't an EOC, a regional response, we rely so heavily on people on the ground and that intel and that support, and the community boards are a big part of us being successful especially in a local response, but also in a regional response. So, you know, those are probably the highlights of the report, and I'm happy to take any questions. Thank you.
Thank you, Ian, really useful, and I can only say you've been bringing a couple of these, I think, over successive meetings, which of course was more than timely given the events that we've all faced here. So again, well done to so we've got questions for Stephen here on the report.
Just a couple from me. Thanks, Chair. Stephen, the triggering of the setup of the Emergency Management Office, what is the requirements for that? Because there seems to be a variance around it. I was informed that it needed a red weather warning, but I take your view that sometimes it's better to have it established, and if things don't turn out the way they are, but most often these days we're thinking they get much worse, and to have it set up and structured is a good way to deal with it.
Yes, Jeff Hamilton asked this question recently, and there's a list of criteria that they use to assess whether an EOC should be set up, and I
just while you're doing that, because it seems to me that the risk for us as a council is that, of course, the responsibility of managing it comes down to individual council members rather than having the EOC manage it, and you therefore run into all sorts of resourcing issues.
Yeah, you're right. I think the here it is. Areas affected. So are the areas spread, you know, across a region? Responding agencies, what agencies are involved? Ongoing weather conditions, so a predicted impact. The time of day, access, including immediate access issues. So are people cut off or not? Communications available. Is there threat to life? What support personnel are available, like in a particular council, to respond to something that's happening, and whether support equipment beyond the ability of a council is required. But the Emergency Management Office say it isn't a black and white decision, and it does incorporate different inputs at different scoring levels. But those are the general things that the mayors would take into account when making a decision on whether to stand the EOC up or not.
I think, if I'm correct, and I'm risking out of my area of expertise, but my impression is that a lot of councils, Rob, will stand up in the EOC but not activate it. In other words, they'll look at the preconditions and be ready and not activate it, which is presumably when you want to have stronger or harder data in front of you, but you are ready to go should the need be required.
And the other consideration or question relates to whether there's a risk to the reputation of the council was in the amount of information that gets conveyed publicly. And councillors had informally discussed this over the last emergency, that we felt there's quite a gap there in the context that there was 9-hour delays on putting updates onto Anteno or information onto the council website, which kept the public informed on what was going on. And sometimes it's just better to put something up very regularly to say, well, there's no updates, as opposed to just leaving a 9-hour gap. That's just a comment.
I take it that's, have you had the point of debriefs at the stage over the past?
Yes.
I take this as a thing that would have been considered, correct?
Yes,
Yeah.
and that comment has been fed back to me already about the delay, and there's a few there's a few considerations there, but I don't want to thrash them out at the table.
Yeah.
With the community board sort of involvement, Nigel's focus at a very, very recent evening that he spent with the Featherston board was in defining, clarifying and answering questions about the different roles of the EOC, the operations centre, an assistance centre, and then the community hub. And just looking at trying to get the relationships, council or official or emergency sort of response and then the coordination and the community initiatives and things. So there's a lot of discussion around that, and that's sort of informing the community board's sort of felt role in talking to the public, which is happening very actively, like in the Featherston market last Saturday was focused on that. Community board engaging specifically on those questions. So, but it's a big area because it brought up things like the relationships, like the assistance centre, and an assumption that a particular institution like ANZAC will be a place for shelter, and then finding out, well, actually, that's not what the ANZAC, all people, the board that runs ANZAC, or even it's a council, institution, but there are different ideas about what's appropriate to happen. And so we're working on those conversations. So, but it's positive, there's action and a lot of goodwill. Mm-hmm.
Okay, thank you for that. So we're facing the impacts of climate change. I think we can say that here in the Wairarapa, and it's an impact on us. So it's useful that we've got this paper, Stephen. So thank you for that. It does obviously show, and even the comments, there's more work, and I know that you guys aren't sitting on your hands. There is other stuff that's occurring. We're just to see where this gets to in terms of ongoing reporting to the committee, which is clear. Are there any other final questions for Stephen before we move to the resolution? Okay, I think it's simple that we just we receive the paper. Do I have a mover and a seconder? Thanks, Chris. I'll second it. I think it's my turn this time. All those in favour, please say aye. Those against, it's carried. Thank you. Capital project summary update. We are low on people, aren't we, Stephen? I think there's only one person I can turn to here. Unless you want to answer this one, Amy, I'll let you have a crack.
Yeah, thank you, Chair. And I am stepping in for James and take the paper as read. These numbers are as reported to the Infrastructure Committee, so they haven't shifted between times. So you're seeing what went to the IC. Really, I'm in a position where I will try and answer questions and receive comments to be fed back from the table on this. Thank you.
Thanks a lot. Okay. So do we have questions on particular projects? We've had from a financial risk perspective, we've had the prior paper where essentially we focused a wee bit, and I think it was at the point you asked to carry forward question, Rob, in terms of dollars, percentage, how we're going. with the projection that in fact the capital program for the year will be largely achieved. I think it's 96% I saw, Stefan. So this is just a modest chance, as you say. There's the infrastructure committee, but in the context of that risk, the sort of the risk question about the financial side, this gives us the physical performance side. And really, I think we should be focusing on anything that might or might not constitute risk. So there's nothing here from a, should we say, a risk perspective, Stefan, that you would think James would have called out.
No, I mean, on a fiscal level, we're landing our budgets both on the capital work side, and roading is also going to land pretty close, which is great. The risk are the pressures that are being put on the business by predominantly emergency response.
Yeah.
And I mean, I know I have mentioned this already, but the pressure on our people has been particularly pronounced, and so I ask you to consider that when you're asking us to do more. That, you know, people are working all of their weekends. They're, you know, we've had people in a position of having to get their laptop out while they're in shopping with their kids, while they're trying to, you know, spend some time with their family on downtime from the previous response. And so we're pushing our people at the moment to the limit. And so I tell you that so that you can be aware of that when you're making asks of us, because it is a risk. People are people, and they can only take so much, and before they just break or leave. So it's really the pressure that we're placing on people, and then the pressure that the emergency responses have on displacement of existing priorities.
Thank you. As you say, it's really at a level of sort of the operational committee's review, but is there anything that you guys want to raise from a risk perspective in terms of these projects?
The only thing was, because I haven't heard back, but between the infrastructure committee, when we looked at this and the last weather event, has anything changed from a risk perspective? And that was the only question I had, and probably the answer I could do that myself would be, we're obviously going to get a report on that at some point.
Yeah, I think
so. For that. Because the bigger question is how it impacts on sort of the project timeframe, which is already noted there, the capex cost of having to divert money into some of these big restoration programs.
But there definitely will be an impact, because it was really was a big one.
Yeah.
I would just ask, and I was thinking about risk, because it's really my role here. I did look at what page is this, 104, you can see from my process, which was about the wastewater treatment plants, and actually all three, Martinborough, Greytown, and ultimately the upgrade at Featherston. Again, my eye was attracted to the right-hand column, which was key risks and opportunities. Most of them seem to be risks rather than opportunities. And I just wondered what I should read from that. Here we go there, Stefan, it's on page 104 of the agenda. So are there concerns from neighbours over land use? And this has become an issue for both Greytown and Martinborough. The new desludging bund location clashes with the wastewater treatment upgrade, etc. I just wonder what the story was there. It seems to me as if there's a bundle of risk around this that perhaps was not anticipated. Is that something for you to come back to us?
Well, no, Chair, probably, I think from my understanding is a lot of that could possibly be updated.
Oh, okay, right. So I'm looking at some Saturday. Okay.
Yeah, because I think some of them, particularly the wastewater management project, has moved on through the consent process and things like that. In terms of concerns from neighbours, well, we know that, but they can reflect that through. If there is has to be a hearing.
Yeah.
that becomes
Okay.
that. So this has changed slightly
Great.
in terms of the process. So I think it just needs to be updated in that.
Well, I'll take it on that basis. Yeah, thank you.
Yeah.
Appreciate that. I didn't want to necessarily
No.
into too
Yeah.
different area. I had to deal with information that was put in front of me. So,
Yeah.
okay, that's fine. So we're out of date. I get that. And it
I
will
think
be-
I just think the overall point is that officers have been, as Stephen has noted,
Yeah.
absolutely waylaid
Yeah.
by other things, and this is stuff that needs to be probably updated. Yep.
I will take that back, Fran, just
Yeah.
if I can feed you a little bit of from.
Oh, yeah, good. I mean, look, I think for the purposes of the minute, it's useful to note.
Yeah.
While the update's there, it doesn't reflect the current position, which, I mean, essentially, while there may be some deferral of addressing through resource constraints, is actually on a better track than perhaps might be first flush reading this. That's
Yeah. I think the clear example would be on the roading and the land transport one that's completely out of date because they've had to reprioritise totally on their project into other areas.
Good.
Yep.
Okay, so we should reflect.
Mm.
And we've had, look, thank you, and I'll leave it at that because you've given us plenty of advice, Stefan, of the ongoing impact of the weather events set on our staff. So folk, it feels like that's probably where we could leave that. So the resolution is that we receive and we note. Rob, I think it might be your turn.
Yeah, my turn. I'm happy to do that.
And if I'm going around in a circle.
Okay.
You're happy to?
Happy to.
Put the motion, all those in favour, please say aye. Aye. Those against, it's carried. Thank you.
We hope in the next 2 months we won't have any more emergencies.
Yeah, well, that's right. Rupert, well, you're on the way.
Yeah.
Will we
Thanks.
lose it more for?
You still, yeah, I'm not officially on it.
We've
Oh,
got-
okay.
Remember, so it's.
Good. Excellent. All right.
We've only got 5 minutes to go, to be honest. So we've got, that's always a kiss of death for a meeting, isn't it? So we only got 5 minutes there. We've got the resolution here on page 113.
I can move that in terms of.
Thank you, and I'll second that. All those in
Yep.
favour, please say aye.
Aye.
Yes, it's carried. Brilliant. We give Amy just a couple of moments.
Yeah.
Very, very changes, that would be good.